Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving deep into the contrasting philosophies of two modern masters of wealth, the aggressive alpha generator and M&A titan, Brad Jacobs, and the profound psychological historian of money, Morgan Housel.
And the stack of sources you've provided us with, it gives just an unparalleled look into how these two define success, wealth, and risk.
But from completely opposite vantage points, right? One is focused entirely on maximizing external performance and, conquering the market.
And the other is focused intensely on achieving maximum internal independence, on conquering the self.
And that sharp contrast delivers our core investment thesis for this deep dive.
It does. We're looking at two definitions of success that require fundamentally different disciplines. Brad Jacobs defines success as alpha generation superior returns achieved by utilizing intense psychological discipline, rooted in techniques like CBT and non-judgmental concentration, to fuel aggressive M&A and revolutionary IT standardization.
Whereas Morgan Housel defines success as autonomy, true freedom, by prioritizing endurance and the systemic paranoia required to stay rich over the ambition and optimism required to get rich.
Exactly. These are two highly successful paths, but the discipline required for each one, well, it could not be more polarized.
That sets the stakes perfectly, and it challenges you, our listener, right out of the gate. What is your ultimate financial goal? Is it a score, a constantly improving report card, validated by external market performance?
Or is it freedom, the ability to define your own time and, the security that comes with low expectations?
So let's unpack the strategic objectives that drive these two masters. Let's start with Jacobs. For him, the goal is ruthlessly clear. Performance as the sole metric.
That's right. Jacobs' entire professional identity is tied to shareholder returns. He views his occupation strictly as making money for shareholders.
It's a contract, then, not a quest for personal fulfillment outside of that single goal.
Precisely. His professional success is explicitly defined by a single report card. The performance of his company's stock price relative to its benchmark index, usually the S&P 500 or, a relevant sector index.
So it's a binary outcome. It's just, did we beat the market or not?
Yes, and he embraces that intensity completely. There's no gray area.
And the track record is not just good, it's historic. When you look at the sources, the returns he has generated define alpha in the purest sense of the word.
Oh, absolutely. They highlight one company he led that returned 32 times the capital invested.
32 times.
And another that generated over 150 times the initial capital for shareholders.
That 150x return is just astounding. Imagine if you had put, say, $10,000 into that venture.
You'd have $1.5 million from that one investment alone. It's incredible.
Yeah, we're not talking about simple market beta here, are we? This isn't just writing the overall trend of the stock market.
No, not at all. We are discussing superior, highly differentiated value creation engineered through relentless, disciplined execution. And given that the only metric is the stock price, it follows logically that Jacobs prefers to hire what he calls raw capitalists.
Raw capitalist. That phrase is intense. What does he mean by that?
He means people who are fundamentally, intrinsically motivated by money and the wealth derived from performance.
That might sound obvious, but I think it's an important distinction.
It is, because many successful organizations employ people motivated primarily by mission or innovation or even status. Jacobs wants pure financial alignment.
So how does he ensure that alignment?
Well, he ensures this by tying employee compensation, especially for his key management teams, strictly to total shareholder return, TSR. This ensures that every member of the band, as he calls it, is perfectly aligned with the overarching shareholder goal, making the stock price go up.
So money isn't just motivation.
It is the binding agent of the entire organization. It's the glue.
So Jacobs measures his worth by the size of the scoreboard and how many championships he's stacking up. Now, let's flip the lens entirely and examine Morgan Housel's philosophy, where the objective isn't measured in market cap or multiples, but in autonomy as the true wealth.
Right.
Housel contrasts the external metrics Jacobs prizes with a definition of success centered on independence, not a number, but a feeling. He describes it as the simple, profound ability to wake up and say, I can do whatever I want today.
This is where Housel introduces the idea of control over your time as the ultimate luxury. It's the highest dividend money pays.
And the external numbers that Jacobs is chasing.
They're merely a means to an end, but Housel believes most people mistake the means for the end itself. He suggests a powerful psychological exercise for the listener, the reverse obituary.
Can you walk us through that?
Sure. If you write down what you truly want to be remembered for, your eulogy, it's always about intangible assets, right? Being a loving parent, a reliable partner, or a thoughtful friend.
It's never about the horsepower of your car, the size of your house, or your annual salary.
Never. That stuff doesn't even make the list. And that reframes the entire mission.
It does. If the goal is internal control and time freedom, then the traditional metrics of richness become irrelevant, or worse, counterproductive.
Absolutely. Housel drives home a critical distinction that is really the cornerstone of his philosophy. Being rich means having a high income that enables you to buy things, often status symbols that are visible to strangers. It is an externally focused state.
That's a performance.
Exactly. But being wealthy is having unspent, hidden money that provides flexibility and independence. Wealth operates in the shadows. It is the money you haven't deployed, the capital that is sitting there doing the silent work of compounding and protection.
That right there is the core psychological divergence between these two masters. For Jacobs, capital is an offensive weapon. It's a tool for production and multiplication used to generate more spectacular alpha.
It must constantly be deployed. In aggressive M&A deals, in large-scale pivots, it can't sit still.
But for Housel, capital is the ultimate defensive shield, a tool for protection and freedom.
And this is why he dedicates so much analysis to the contradictory skills required for long-term success. Optimism, boldness, and risk-taking are necessary to get rich, to build that initial fortune from nothing.
But those very same skills can be lethal once you achieve success, can't they?
They often are. The conservative virtues of deep, sustained paranoia and frugality are absolutely required to stay rich and protect the resulting independence from unexpected events.
Whether they are geopolitical shocks, technological disruptions,
Or even the forces of your own personal ego. The goal is endurance, not speed.
endurance versus peak performance. That contrast forces us to look closer at the mental effort required to execute Jacobs' high-performance strategy. It's not just mechanical, it's profoundly psychological.
It is.
So let's move from the objective, which is alpha, to the strategy, M&A, and the refined cognitive toolkit he uses. We are exploring the inner game of alpha.
I love that framing, because Jacobs really does view his mental discipline, developed over years of effort, as his primary source of competitive advantage in these high-stakes environments where others are reacting emotionally.
It's a fascinating insight into his process. Our sources reveal that he actively and systematically studied the principles of cognitive behavioral therapy, CBT, and rational emotive behavior therapy, or REBT.
Yeah, pioneered by figures like Albert Ellis and Aaron Beck. And his goal was purely practical, to eliminate cognitive distortions.
So those instant, automatic negative thoughts and emotional biases that cloud judgment and lead to expensive financial errors.
That's it. He saw his own emotional wiring as a liability that needed to be debugged, almost like a piece of inefficient software.
Can you give us a concrete example of a cognitive distortion that could ruin an M&A deal?
Certainly. One major distortion is catastrophizing. Imagine a market shock hits and the share price of a target company drops 40% overnight. The irrational cognitive distortion screams, "The whole economy is collapsing. If I buy this, I'll look like a fool and lose everything."
Which leads to panic and freezing up.
Right. But Jacobs, having internally debugged this distortion, sees the 40% drop not as a catastrophe, but as a temporary discount. It's a sudden, unplanned opportunity to buy the asset cheaper than anticipated.
He realized the human mind, left unchecked, is prone to making emotional, expensive errors during a crisis.
And CBT is his way of installing a rational firewall. He applies this discipline religiously, particularly when billions are on the line and the market is swinging wildly. By rearranging his brain, he ensures he remains perfectly calm and collected.
And that calm allows him to capitalize on unplanned circumstances rather than being overwhelmed by them.
Right. It's not about suppressing emotion. It's about ensuring that critical decision-making is purely rational and data-driven.
And here is where his philosophy touches on the future. It's fascinating that he views the ultimate expression of this rational enhancement as future technology. He has publicly discussed his vision of AI acting as non-stop therapy.
Constantly monitoring human bias and enhancing our rationality and constructive thinking. It's a wild idea.
Wait, that raises a crucial question that connects directly back to Housel's philosophy. Housel views true wealth as internal, the hard-won psychological skill of controlling your own expectations.
Yes.
If Jacobs believes we can ultimately outsource self-control and rationality to AI, isn't he missing the essential human struggle for discipline that House insists is necessary for real contentment?
That is the core philosophical tension. Jacobs is the architect seeking to perfect the machine, the human brain, through technology and behavioral science. He wants peak performance.
And Housel's the stoic, arguing that the effort of control is the reward, that the discipline itself builds the psychological wealth.
It's the difference between using a calculator and learning to do the math in your head. Jacobs wants to optimize the result. Housel values the process of internal growth.
I love that distinction. Now, let's stick to the M&A process where he applies this mental clarity. The sources detail another cognitive technique he uses, non-judgmental concentration, during due diligence and negotiation.
This is crucial for unlocking hidden value. It is a hallmark of his approach.
So what does that mean in practice?
Non-judgmental concentration means giving a speaker, say the CEO of a target company, 100% of his attention without permitting himself to formulate an immediate counterargument, a rebuttal, or an internal judgment about what the speaker is saying.
He's just absorbing the information.
Completely. That seems like common courtesy, but in a high-stakes M&A negotiation where egos are flying, it must be revolutionary.
It must be.
It is, because it disarms people. When people feel heard and not immediately scrutinized, they become vulnerable. This technique creates a safe place during due diligence.
And that encourages honesty and truth-telling.
Yes, often revealing deep, messy weaknesses in the target company's structure that adversarial approaches would never uncover. He practices what he calls joining then leading, or validating then disputing.
You acknowledge the speaker's point completely, absorb the truth.
And then you can challenge it later, rationally and without emotion.
And the messy truth, the weaknesses, the chaos, that is precisely where the value is hiding for Jacobs. He sees that chaos, the disorganized structure, what he calls the spaghetti organizational chart.
And recognizes the massive opportunity to unmess it. And this ability to adapt and pivot quickly is rooted in a surprising influence, his jazz philosophy.
This is one of the most unique aspects of his methodology. He self-identifies primarily as a musician, not a business person.
Having trained with avant-garde jazz legends like Milford Graves and Bill Dixon early in his life, he absorbed their whole approach to improvisation.
So how does avant-garde jazz translate into the management of a multi-billion-dollar enterprise?
It translates into radical market responsiveness and a rejection of rigid planning. Jacobs rejects the typical rigid multi-year business plans because markets, regulatory environments, and technologies are constantly changing.
So trying to stick to a 5-year plan in a world that shifts every 6 months is the definition of financial rigidity.
It's a recipe for disaster. So if the market shifts, say a massive competitor enters the field or a supply chain breaks down, that's not a crisis.
It's a change in key signature.
Precisely. The core philosophy he took from jazz is there is no wrong note. A shift in reality, an unexpected event, isn't a failure to be corrected by sticking harder to the original script.
It's a new note that you must immediately incorporate and improvise around.
It's an opportunity to adapt and capitalize on the new circumstances created by the market dissonance.
We see this beautifully illustrated in the sources with the 2015 Conway acquisition.
Yes.
At the time, XPO, his company, was proudly asset-light. They didn't own the trucks or the terminals. Conway was the exact opposite, an asset-heavy traditional trucking and logistics company.
The purchase of Conway was a massive, highly criticized pivot. It was a $3 billion deal that required Jacobs to abandon the asset-light identity he had built up in the market's eyes.
And the market pundits were saying,
he has lost the plot. This is a massive strategic mistake. Yet he proceeded based on his conviction that he could create immediate, measurable value by taking Conway's chaotic, inefficient organization, that spaghetti chart, and imposing his standardization playbook on it.
And the result was spectacular. That specific asset later grew to be worth roughly $15 billion after strategic pivots.
Which demonstrates the courage to improvise, ignore the original script, and immediately adapt based on data and the potential for fixing internal inefficiencies.
It proves that the disciplined execution of the jazz philosophy, turning a discordant market note into a profitable, harmonious pivot, trumps sticking to a non-flexible 3-ring binder plan.
The risk he took was massive, but it was calculated and rooted in his belief in his own psychological ability to execute the turnaround.
Okay, so we've explored the psychology of execution. Now we move to the strategy of capital allocation. Where is he putting his massive resources? For Jacobs, M&A is not just buying companies, it's advanced R&D.
He is not seeking perfection. He views the entire acquisition process as research and development aimed at finding industries and companies with messed up organizational charts.
The ones that look genuinely chaotic, like spaghetti or abstract art, where no two systems are alike.
Exactly. He applies his discipline, mathematical, and musical lens to resolve that dissonance. The goal is to unmess the chaos and unlock massive shareholder value in the process.
And this strategic vision has led directly to his new venture, QXO. The sources indicate Jacobs is explicitly betting on the $800 billion sleepy market of building products distribution across North America and Western Europe.
That's right.
Why that specific market?
It's the perfect target for the Jacobs playbook. The opportunity lies entirely in the technological inertia of the industry. He notes that while there are roughly 20,000 distributors in that sector, only a tiny handful are applying modern technology, cloud computing, and integrated systems.
So the sector is what he terms sleepy regarding tech, relying on fragmented legacy systems.
Exactly. He sees a huge fragmented ocean of mid-sized companies that are all operating inefficiently because they haven't adopted modern technology.
And that creates a massive multi-billion-dollar opportunity for a tech-forward advantage.
A huge one. And his ambitious goal is not modest. He intends to use the power of M&A, technology, and standardization to build QXO into a $50 billion company.
$50 billion. So he's looking to capture roughly 6% of that total addressable market through aggressive M&A and organic growth.
It's a huge bet on the inefficiencies of the legacy distribution system.
And crucially, he is putting his money where his mouth is, signaling incredible conviction.
Absolutely. The initial capital structure is formidable. Jacobs and his wife are personally investing a staggering $900 million into QXO.
$900 million.
And that's complemented by $100 million from friends and family, including longtime partners like Sequoia Capital, totaling $1 billion in initial equity.
That kind of personal investment signals not just confidence, but deep alignment with shareholders.
If he is risking nearly $1 billion of his own family's capital, you know he believes in the execution. Moreover, he is getting the band back together with the same successful founding management team from his XBO days.
So he's relying on proven human capital to execute the standardization playbook that generated those 32x and 150x returns previously.
Exactly right. But underlying all this aggressive, high-octane growth and technological deployment is a core philosophical belief about the future.
Right, the main trend.
Yes, that's where he incorporates the advice of his mentor, Lud Jorson. Get the main trend right. Jacobs is looking at the accelerating rise of AI and the technological singularity, which is Kurzweil's vision of technology merging with human capability, as the overarching context for all future business success.
And he believes the trend is overwhelmingly in favor of those who apply technology aggressively.
Absolutely. And what's the risk of getting that trend wrong or simply ignoring it?
Well, he warns that missing this trend, the accelerating compounding power of technology, is like swimming upstream against the most powerful current in modern economics.
It means constant struggle, increasing inefficiency, and eventual irrelevance. His QXO strategy is entirely designed to ride that main technological trend, not fight it.
Despite the high-growth ambition, he applies a surprisingly rigorous discipline to his risk profile, which he describes using a wonderfully contradictory phrase, a Zen Buddhist approach to debt.
It's a great phrase, isn't it? It perfectly encapsulates the Jacobs approach to leverage. He acknowledges that debt or leverage is necessary to improve returns. It allows you to reduce share count or scale faster than retained earnings would allow.
But he warns that excessive debt is the one thing that risks total instantaneous bankruptcy during unpredictable geopolitical shocks.
Citing the global volatility we saw during the COVID-19 era.
So how does the Zen Buddhist approach manifest in practice for QXO?
Financial discipline. He targets a healthy, conservative leverage ratio of 1 to 2 turns of EBITDA.
And just for our listener, explain why that's significant.
Well, in the world of private equity and highly aggressive M&A, leverage ratios can often climb to 4, 5, or even 6 times EBITDA. A 1-2 turn ratio is extremely conservative for an aggressive growth play.
So it demonstrates that even a high-growth alpha seeker is fundamentally obsessed with avoiding the catastrophic, unrecoverable error.
That's the Jacobs definition of risk management. Enough debt to maximize returns and ensure rapid growth, but never enough to risk being wiped out by a shock that nobody saw coming. He prioritizes survival in the face of macro volatility.
Which brings us full circle back to Housel's world. If Jacobs uses psychological discipline as an offensive weapon to generate alpha,
Housel focuses on psychological preservation as the ultimate allocation strategy. This is the defensive shield, designed to protect the capital that Jacobs is trying to multiply.
Housel zeroes in on the profound difference between chasing external validation and achieving internal tranquility, often defined by controlling the gap between ego and income.
Yes. He warns against chasing fleeting happiness, which is always transient and elusive, advocating instead for sustainable contentment.
The state of having enough, the quiet satisfaction of self-sufficiency.
Exactly. And he diagnoses the financial trap most people fall into: the treadmill of expectations. This treadmill is an endless, self-imposed race where acquiring status symbols only resets the goalposts higher.
The moment you buy the bigger house, you immediately become dissatisfied because you start focusing on the even bigger house your neighbor or colleague just purchased.
You feel perpetually behind, perpetually dissatisfied. It's a vicious cycle that leverages our inherent need for social validation.
And Housel directly confronts the root of this behavior by addressing what he calls the spotlight bias.
Right. We profoundly overestimate the extent to which strangers, the audience we are spending money to impress, actually notice or care about our spending.
That expensive car, that designer watch, the strangers on the street glance at it for 3 seconds.
And then immediately return to thinking about themselves.
So the spending is often a waste because the intended audience isn't paying attention anyway.
Worse than a waste, Housel notes. Spending money to impress others doesn't actually foster admiration. It fosters envy, which often manifests as resentment or outright hate.
So when you acquire status symbols, you often gain critics, not allies.
Pretty much. His core counsel, therefore, is crucial. True wealth is unspent money. It is the critical, protected gap between your ego and your income. This unspent portion is the real asset.
Providing flexibility and independence, which Housel views as priceless.
It reframes the entire mission of saving. Saving isn't deprivation, it's the purchase of future control.
Precisely. And the final, most powerful layer of Housel's defensive strategy is the power of controlled expectations.
Yes, he points out that money doesn't fundamentally solve internal psychological problems. It acts as leverage on your existing personality.
Money doesn't fix an anxious person.
It often makes them more anxious about losing what they have. It doesn't fix a happy person, but it often gives them more resources to sustain their happiness.
So the true financial skill lies not in market mastery, but in psychological wealth-controlling internal expectations.
It's the ultimate cheat code. He cites the stunning, highly relatable example of his grandmother-in-law, who was perfectly content living off $1,800 a month in Social Security.
She was wealthy because she needed nothing.
It demonstrates that the control of one's desires is the most powerful financial lever of all, often exponentially more powerful than increasing income. Housel wraps this entire defensive strategy by offering a profound warning to the high-performance crowd.
Which is?
FOMO, the fear of missing out, is not a harmless anxiety. It is often recklessness masked as ambition, leading people to outsource their critical thinking and disciplined decision-making to the emotional crowd.
What a beautiful counterpoint to Jacobs' aggressive deployment. If Housel teaches us that the best defense is controlling the self, let's now turn back to Jacobs, who uses that very same internal psychological control CVT, not defensively, but as his most potent offensive weapon.
Right.
We need to deconstruct his alpha formula into its 2 tangible, massive financial levers.
Absolutely. Jacobs generates alpha using 2 specific, repeatable mechanisms, which he is careful to distinguish from the foundational elements, people and technology, that enable them.
So the 2 biggest levers for generating financial returns, according to Jacobs, are the valuation spread and operational improvement.
Those are his 2 main sources of value.
Let's start with lever #1, the valuation spread, capital arbitrage, which he identifies as the biggest lever. This relies heavily on his track record and reputation.
This is the genius of using trust as a financial asset. The mechanism is simple to state, but almost impossible for anyone else to replicate.
Walk us through it.
Jacobs's proven history allows him to raise capital from massive institutional investors like sovereign wealth funds at extraordinarily high implied valuations, often high multiples on future earnings. This means his capital is expensive or highly valued when he raises it.
Okay, so he raises expensive capital, then how does he deploy it?
He then strategically deploys that capital to acquire private companies, usually distributors in those sleepy, fragmented industries, at significantly lower EBITDA multiples.
Okay, let's use a simpler analogy to make this mechanism clear to our listener.
Think of it like a guaranteed margin on a transaction. He raises money from a sovereign wealth fund, effectively agreeing that his management team is worth a 15x multiple on future EBITDA.
Okay, so a 15x multiple.
He then takes that capital and uses it to acquire a target company full of that spaghetti chaos at a 7x multiple.
So wait, he raises it 15x and buys it 7x. That's an instant doubling of value right there.
That's the delta, or spread. The difference between the 15x valuation he raised at and the 7x valuation he acquired at creates instant shareholder value from day one. It's the closest thing in high finance to buying a dollar for 50 cents, guaranteed from the moment the ink dries on the deal because of his market reputation. It is capital allocation brilliance.
That explains the initial burst of value. Now for the second engine of growth, liver, #2. Operational improvement, which is the second biggest lever and is what sustains that value long term.
This is where the M&A playbook converts internal organizational chaos into pure cash flow. The mechanism here is extreme, non-negotiable integration and standardization.
He systematically takes those messed up companies with fragmented, often redundant systems and applies discipline to unmess them.
It's radical consolidation of systems. He mandates a single, unified ERP enterprise resource planning system for closing the books across all acquired entities. He requires a single HRIS human resources information system for all personnel functions and a standardized CRM system.
So instead of 20 different subsidiaries using 20 different accounting or logistics systems, they all must conform to one.
Exactly. And the immediate effect of that forced standardization is huge. It substantially increases profit margins, cash flow predictability, and overall asset performance.
Because when every part of the organization speaks the same language, management can instantly see where the bottlenecks, inefficiencies, and hidden costs are.
It turns low-margin, chaotic assets into high-performance, standardized superorganisms. This is where the technological edge in the sleepy building distribution market for QXO will truly be realized.
We must also clarify the role of the needle movers, people and technology. Jacob stresses these are not the levers themselves, but the foundational elements that enable the levers to work.
Exactly. They are the fuel and the engine. People are cultivated using that love vibe, but it's a focused love. The goal is to build teams that function as a superorganism, a seamless, high-trust entity.
Which requires hiring those specific raw capitalists and ensuring their compensation is tied strictly to total shareholder returns, or TSR.
Right. When employees get spectacularly rich only when shareholders do, alignment is absolute.
And technology is the second half of the foundation.
Technology is the essential tool for lever #2, operational improvement. In sleepy markets, simply applying basic modern cloud technology creates an immediate, massive competitive moat that is difficult for legacy competitors to cross. Technology is the infrastructure that allows the standardization playbook to eliminate the organizational spaghetti.
This brings us to the ultimate synthesis, the comparison that defines the modern investment journey. We see Jacobs as the high-variance, risk-embracing conductor, and Housel as the low-variance, stoic historian of preservation.
That is the definitive analogy. Jacobs is the jazz conductor, pursuing a strategy of high-variance alpha generation. His entire playbook revolves around aggressive pivots, massive M&A, and betting enormous sums of capital on the long-term technological trend of AI and the singularity.
He leads the band, demanding that they improvise around the inevitable wrong notes, the unplanned circumstances and market dissonances, and turn that discordant chaos into a profitable melody.
And his discipline, rooted in CBT, is entirely offensive, designed to maintain the razor-sharp rationality necessary for peak financial performance under pressure.
And against this backdrop of aggressive alpha, we have the counterpoint.
In contrast, Housel is the stoic historian whose strategy is built on low-variance preservation. His primary goal is not maximizing the return curve, but ensuring the vehicle survives the journey intact so that compounding can work its magic over decades.
His focus is on endurance, survival, and long-term psychological stability.
Which requires intense psychological wealth. The immense quiet ability to control internal expectations and resist external status seeking, so that the financial wealth, the unspent money, can compound undisturbed by the destructive forces of ego or reckless ambition.
The ultimate implication for you, the listener, is the inherent trade-off in each path. You must choose your desired form of discipline. Jacob's pursuit of maximum performance requires the constant high-stakes, pressure cooker effort of the Formula One driver, always pushing the limits, always making calculated pivots under extreme pressure with the ever-present risk of wiping out.
Housel's quest for autonomy, on the other hand, requires a different but equally constant effort. It requires the relentless discipline of the Stoic to control their own mind, their desires, and their ego, ensuring the internal machine is stable enough to allow the financial machine to run uninterrupted. The question is, which form of discipline is more sustainable and desirable for your unique financial personality?
That distinction, the effort required to constantly perform versus the effort required to constantly contain the self, leads to a final provocative thought to leave you with. Jacobs is deeply open about his psychology, even admitting to a high need to be appreciated.
Right.
He derives significant confidence from the external validation of his mother, his co-investors, his employees, and the market's response to his share price.
That's a key piece of vulnerability.
So if the aggressive pursuit of alpha generation and superlative performance, the building of that $50 billion QXO, is fundamentally driven, at least in part, by the need for external validation, does that inherently mean that Jacobs's path, despite its spectacular returns, is fundamentally dependent on external forces?
And if so?
And if so, does that make Housel's quiet contentment, his internal self-directed psychological wealth, the true path to ultimate unassailable control?
That is the trade-off inherent in wealth creation and preservation. Thank you for diving deep into these contrasting philosophies of discipline and destination.
Risk defined, portfolio protected.